Shares. Shares are a popular type of investment instrument or security. The idea of share ownership originated in the early days of English exploration, when expeditions were mounted to far-flung regions in search of riches. For those prepared to take the risks involved, a successful expedition could make them large profits. However, such ventures were very expensive and often relied on royal patronage, funding. In addition, private investors might contribute. For example, if a venture cost £10 million to mount, this might be obtained from 10 investors, each contributing £1 million. Funds obtained this way became known as equity capital, because investors were part owners, that is, they had an equity in the enterprise. Notes: capital is just another name for money or cash used for business purposes. Shares are also known as equities. Apart from equity capital, a business can also obtain capital by means of loans from banks or financial institutions. This capital is known as loan capital. The idea of issuing shares to obtain equity capital for business ventures caught on in capitalist economies. Soon, several refinements were introduced. These included issuing shares with smaller monetary value. That is, instead of raising £10 million by issuing 10 shares of £1 million, the same capital could be raised by issuing 10 million shares at £1 each. As shares had a value, they could be traded between willing sellers and buyers. Indeed, it was possible to make a profit by trading shares without actually participating in the enterprise. Originally, share trading was done at the Royal Exchange, and then in coffee houses where investors gathered. But by 1748, share trading was so popular that a dedicated stock exchange was set up in Threadneedle Street, London. Soon, this idea spread throughout the world, and today, most countries have their own stock exchanges. Stocks and shares. The words stocks and shares are often used interchangeably, but really they have slightly different meanings. Shares are the smallest equal units of division of ownership in a business enterprise, whereas stock is the sum total of all those shares. For example, all shares issued by Woolworths comprise the total Woolworth stock. If you buy some Woolworths shares, the number of shares you own determines the extent of your equity in the company. In this case, Woolworths. Company. A company is a legal entity in its own right. That's to say, in law, it is regarded as a body that's distinct from the owners. This legal body is known as the body corporate, and it can do many things a person can do, such as enter into legal contracts, sue or be sued, buy or sell commodities, hire or fire personnel, own assets, including stock, machinery, real estate, and cash. For business purposes, the great advantage of a company is that the owners cannot be held liable for the debts or contracts of the company. This is different from business enterprises such as sole proprietors or partnerships, where there is no body corporate and the owners are liable for contracts and their assets can be used to repay debts if necessary. Public versus private companies. As the name suggests, a public company is one where anyone can buy shares in the business and so be a part owner. This is different from a private or proprietary company, Pty Limited, which is limited to 50 shareholders, and the public at large can't become shareholders unless the company floats, that is, converts to a public company. Public companies are listed on a securities exchange, so the shares are available to all, whereas private companies are not listed and you cannot become a part owner unless invited. Public companies